Welcome to The Explainer. Today, we're diving straight into a focused, objective look at the 2026 Costa Rican liquidity market. Specifically, we'll be examining the current state of money market funds, checking out historical trends, recent performance metrics, and the underlying economic factors that are really shaping yield expectations today.
Here's a quick look at our roadmap. First, we'll map out the money market fund landscape. Second, we'll trace the historical yield evolution from 2019 to 2026. Third, we'll examine the specific May 2026 yield data. Fourth, we'll unpack the exchange rate impact. And finally, we'll wrap up with the valuation criteria and strategic implications.
All right, let's jump right into Section 1 and establish exactly what kinds of financial vehicles we're talking about here.
At its core, a money market fund, sometimes called a short-term investment fund, is a pooled investment vehicle. It's professionally managed by a SAFI, which is short for Sociedad Administradora de Fondos de Inversión. Essentially, these funds pool capital from multiple investors and allocate those resources into short-term financial instruments. We're talking about underlying assets like bank deposits, sovereign bonds, repurchase agreements, and other highly liquid securities.
Now, just to set the stage properly, all the conceptual definitions, explanations, and comments regarding investment funds, SAFIs, and related concepts that we're covering today correspond to Marco Orozco's analysis.
Moving on to Section 2, let's look at how the broader economic environment and interest rate dynamics have influenced fund performance over time.
It's really helpful to trace this timeline to understand the current interest rate cycle. Back in 2019, yields for colón-denominated money market funds were hovering right around 5%. Then, as monetary policy eased, we saw a progressive decline, with yields dropping down near 1% during 2021 and early 2022. But then, things shifted aggressively in 2023. Rising inflation triggered a monetary tightening cycle that pushed the monetary policy rate up near 9%, which naturally caused fund yields to pop back over 5%. However, as inflation returned to contained levels throughout 2024 and 2025, a gradual reduction followed, bringing us to where we are in 2026.
And that brings us to the key number today, 3.25%. That's the current benchmark monetary policy rate set by the central bank. It's obviously significantly lower than those 2023 peaks, and that downward adjustment transmits directly to money market fund yields. They've been on a steady downward trajectory, which basically means yield expectations for the coming months are much more moderate compared to the height of that rate hiking cycle.
So, how does that translate into actual numbers? Let's move to Section 3 to break down the detailed performance across different currencies.
For this segment, it's important to note that the performance data for money market investment funds in colones and US dollars comes exclusively from the Sugival biweekly bulletin for May 2026.
Starting with the colón-denominated funds, the top-performing ones posted 30-day yields ranging from 3.47% down to 2.54%. The top leader hit 3.47%, followed by 2.69% in second and 2.55% in third. These posted the highest yields in this particular segment. Also, that leading fund has maintained its top position in both short-term yields and on an annualized basis in the 12-month ranking, showing some notable consistency.
Now, let's look at the US dollar-denominated funds, because there's a pretty clear contrast here. These posted slightly lower and much more closely clustered yields. We're seeing 2.98% in the lead, followed very closely by 2.92% and 2.90%. While yields remain tight across the board here, there's actually a slight moderation observed compared to the first half of May, when levels reached 3.06%. And while the top-performing funds here do maintain their leadership in the 12-month ranking, there's definitely more short-term turnover compared to what we saw in the colón segment.
Let's transition to Section 4. We need to unpack a major factor that complicates these nominal yields, exchange rate dynamics.
Let's walk through the math of currency translation. Over the last few years, the local currency has demonstrated significant appreciation against the US dollar. Because of this, analyzing nominal fund yields alone really isn't sufficient anymore. Think about it. If an investor earns an annualized yield near 3% in a USD-denominated fund, their net return could end up close to 0%, or even negative if the colón appreciates by a comparable or greater percentage over that exact same time frame. It effectively reduces returns for investors holding USD-denominated assets who convert those gains back into colóns.
Finally, in Section 5, let's review the evaluation criteria and what this all means strategically for liquidity portfolios in the current environment. When evaluating a money market fund, you have to look beyond just recent performance. Specific evaluation criteria are absolutely necessary. We're looking at long-term performance consistency, the credit quality and diversification of the underlying portfolio assets, liquidity terms and redemption flexibility, and of course the operational efficiency of the managing SAFI. During periods of declining rates, the SAFI's active management capability and the historical stability of its investment process become decisive factors in preserving a fund's relative competitiveness.
All of this points to a distinct conclusion. The current financial environment, defined by gradual yield compression, warrants more moderate return expectations. Therefore, the scenario favors the periodic reassessment of allocations across cash holdings, short-term investments, and longer-term investments. Factors like fund selection, currency denomination, and investment horizons have acquired significantly greater importance. Navigating this environment demands a sophisticated analysis to properly balance return, liquidity, interest rate risk, and currency risk across allocations.
To wrap things up today, we must note that persistent macroeconomic risks are still present, and they could alter this outlook. Potential inflationary pressures stemming from international energy price volatility and evolving global geopolitical dynamics remain. If these risks materialize, how might they impact future central bank interest rate decisions? Could the monetary authority be compelled to maintain current rates or reconsider future easing? It's a critical question to consider for any liquidity strategy moving forward. Thanks so much for joining us for this explainer.